Most people believe this simple rule: buying stock is investing. Options used properly can be safer than buying stocks outright. Safety by simplicity is not the same as safety by design. When you buy a stock, your downside is open. Risk should be defined before reward is considered. Namaskar. You are listening to Rye Perspective, where we separate market myths from market mechanics. Most people believe this simple rule: buying stock is investing, trading option is gambling. Today, I want to slow that down and examine whether that belief is actually true. Because when you look at the risk, capital efficiency, and probability, you often discover something uncomfortable. Options used properly can be safer than buying stocks outright. Let's be honest. Stocks feel safe. You buy shares, you hold them, you wait. There is no expiration date, no Greeks, no complexity. But safety by simplicity is not the same as safety by design. When you buy a stock, your downside is open-ended. Your capital is fully exposed. Your return depends on one thing only: price going up. That's not controlled risk. That is unstructured exposure. Here is a foundational principle taught by Option Alpha. Risk should be defined before reward is considered. Stock trading violates this principle. If you buy a 5 lakh worth of shares, you don't know your maximum loss. You don't know how long capital will be tied up. You can't shape outcome. Options flip this completely. When you buy an option, your maximum loss is fixed. Your capital at risk is capped. Your exposure is intentional. Ask yourself this: what is riskier? Losing 5 lakhs slowly in a falling stock, or risking 30,000 with a clearly defined worst case? Options don't add leverage blindly. They compress risk into a controlled unit. Options allow you to control risk with less capital. To control 100 shares of a stock requires full capital. Options requires a fraction. That unused capital isn't wasted. It's risk buffered. It can stay in cash. It can be diversified. It can be redeployed. So options are not about taking more risk. They are about using less capital for same exposure. That's efficiency, not speculation. Stock trading is a prediction heavy. Direction must be right. Timing must be right. Market must cooperate. Option Alpha teaches something different: probability based trading. Options allow you to profit when market rise, market fall, market stay flat. We don't need to predict what will happen. You define what must not happen. This is why strategies like spreads, iron condors, premium selling exist at all. Stocks have one payoff shape. Options let you engineer payoffs. Here is where the stock versus option debate truly breaks. Stocks offer capital appreciation, maybe dividends. Option offer income, protection, flexibility. Options as tools, not bets. Covered calls generate income. Cash secured puts pay you to buy stocks cheaper. Protective puts insure portfolios. This is how institutions think. Retail investors accept drawdowns. Professional designed around them. Now, that part of Option Alpha never sugarcoats, and neither will I. Options demand discipline, position sizing, consistency. Time decay punishes impatience. Leverage punishes ego. Options are dangerous only when treated as shortcuts. Used as a system, they reduce randomness. Used emotionally, they accelerate failure. This is not a tool for excitement. It's not a tool for structure. So let's conclude clearly. Stocks are simple but blunt. Options are complex but precise. Options don't eliminate risk. They force you to confront it upfront. That's why professional traders don't ask, is this risky? They ask, is this risk defined, sized, and repeatable? And that's the mindset shift that separates speculation from strategy. I will break down option buying versus selling, income strategies, and how to apply this in Indian market step by step. Until then, remember, options aren't gambling instruments. They are risk management instruments. And like all powerful tools, they reward discipline, not hope.